Okay, this is going to be part 3, the final part of chapter 7. All right, one other limitation on capital losses is called wash sales. All right, so if I sell stock and then within a short time before or after the sell, I buy the same stock back, I can't deduct any loss, right? So specifically, if I take the date of the sale and I go that day plus the 30 days before and then the 30 days after, I have a total of 61 days. So if I replace the shares that I sold on this day with substantially the same shares, either right within this period, then I can't deduct any loss. It's called a wash sale, right? It's a wash because afterwards I end up with the same shares I had before. I didn't really change my position. All right, why would they have this rule? All right, so right now is a good time to think about it, right? Stocks have crashed because of the virus. And so, right, let's say I hold stock that I still think is a long-term investment. I've got stock in Apple, and I still think in the long term I want to hold it. So I don't want to get rid of it, but I think I'll just sell it now. I'll deduct a loss to save on taxes, and then I'll buy it back. All right, this is what that's designed to prevent. It says if you want to deduct a loss, you have to really liquidate your position. All right, so right, you can still do it but you have to hold it, right? It gives you a little more risk of the price changing on you, right? But so you can sort of do that same strategy, but it has to be outside of this window. All right, so what's his name? Blanking on his name, Pershing, Bill Ackman, the hedge fund guy, right? He just made a whole bunch of money shorting the market essentially, right? He kind of guessed it would crash because of the virus. And so he paid $26 million and he made $2.7 billion. And he also sold a lot of his stocks. And then he's going to wait until after the window and buy them back or increase his positions. All right, so the rule is designed to prevent people from deducting losses without what we call economic substance, without really getting rid of their shares. So how this works is, all right, let's say Ben owns 100 shares of Tower Inc. His basis is $400 per share. On December 5th of year one, he acquires 100 more shares of Tower Inc., right? So he's trying to be clever by replacing his shares before he actually sells the original shares. All right, so the price is now $300 a share. Then on December 31st, he sells his original 100 shares for $300 a share. All right, so he's realized a loss, right? His basis was 400 and he sold them for 300. So he has a $100 per share loss. But because he bought substantially the same shares, substantially the same means he could have bought an option to buy the shares, and that would also be a wash sale, right? Or he could have bought debt convertible into equity, right? Right, but since he bought the same shares within that 61-day period, he recognizes $0 of that realized loss. So the thing that happens though is now he did buy these new shares at $300 a share. So what he gets to do with that loss that was disallowed is kind of like in our like-kind exchange, he adds it to his basis, right? Because his basis in the new shares is $300 a share. So if he sold them now, he wouldn't get a loss, even if he didn't replace them. So he gets to add the disallowed loss to his new shares, so he has the same basis as before. So if he sells them and doesn't replace them, he will have a recognized loss. All right, what if similar facts, except he didn't buy all 100 shares back. He only bought half of them back. He bought 50 shares on December 5th, and then he sold his 100 original shares on December 31st. All right, well now on those 50 that he replaced, it's a wash sale. He can't recognize the loss on those, but on the 50 that he really did share and not replace, he can recognize the loss, right? So in this case, because he replaced half of the shares, he can't recognize half of his realized loss, but he does recognize the other 5,000. So now only 5,000 of the loss has been disallowed, and that 5,000 he'll add to his basis in the new shares. So he'll have a basis of 20,000 in the 150 shares that he owns. No, in the 50 shares that he owns. Just checking if I, yeah. All right, so some takeaways we can learn, right? You can impress, I guess you can't really impress people. We don't see people anymore in person. If this ever ends and you're at dinner with your family or friends, you can impress them with some tax advice. You can say, hey, if you have a capital asset and you're thinking of selling at a gain and you've held it for almost a year, you might want to wait for at least until after a year, because then you get the preferential long-term capital gains rates instead of the ordinary short-term rates. Plus, the longer you wait and defer tax, the more you benefit from the time value of money. Loss harvesting is another tip. That means if you already know you're going to sell some assets at a gain and you have some assets that have declined in value, it might make sense to sell your losses at the same time as the gains, because then you can net the losses against the gains and reduce your gain that gets taxed. And you can also, right, you take up to $3,000 of net losses to reduce ordinary income. So we call that loss harvesting. Right? If you don't expect these assets to go up much, or you'd rather invest in something else, you can harvest those losses. So all else equal, hold gains and sell losses, right? All else equal, doing a lot of work there. Okay, investment interest expense, right? We mentioned there was one expense here that's going to be a below the line itemized deduction. So investment interest is interest on money you use to buy investments. Classic example would be a margin loan you use to buy stocks. So you can deduct that interest on those loans, but only up to the amount of net investment income. In this case, net investment income equals gross investment income. I don't understand, you say. Well, you used to be able to deduct investment expenses, right? So for tax purposes, you did have a net income. Congress got rid of the investment expense deduction. So we're basically just using gross investment income as net investment income. The other thing about it, though, is net investment income is gross, but it only includes investment income that's not taxed at preferential rates. So it excludes, right? You can see in this list, we have interest, annuities, royalties, short-term capital gains, and non-qualified dividends. All right, we've excluded long-term capital gains and qualified dividends. So those things that get the preferential rate, they're not counted as net investment income, right? And so the income from those preferential things doesn't count towards what we can deduct in terms of interest. Let's take an example. Lainey has AGI of 50,000, including 3,550 of long-term capital gains, 2,400 of short-term capital gains, 250 of qualified dividends, and 1,200 of interest from corporate bonds. What is her net investment income? Right, for purposes of, this is confusing, right? Because we have the net investment income tax. This would all count as net investment income. For purposes of the investment interest expense, only the short-term capital gain and the corporate bond interest count as her net investment income, right? For purposes of this investment interest expense, we're excluding long-term capital gains and qualified dividends. If Lainey incurred $4,000 of interest on loans she used for investments, how much of that can she deduct? Right? She can only deduct up to her net investment income, right? Which means she can only deduct $3,600. The rest of that $4,000, the $400, she can carry forward, and she can deduct it as soon as she has enough net investment income. All right, so that concludes what we're talking about with portfolio income. Now we're going to talk about passive activity income and losses. So here's a fun tax case, can show you what we mean by passive activities and why we care. So this tax case was called Estate of Franklin, right? Because by the time it got to court, Franklin was dead. But Franklin was a dentist. He was in a partnership with other dentists, right? So dentists are always looking for tax shelters. All right, so they entered into a transaction with the Romneys, right? Not related as far as we know to Senator Mitt Romney, but there was a older couple in Arizona who owned a motel. So what happened is the Romneys sold the motel to this partnership of dentists. They also loaned them the money to buy the motel, right? It's called seller financing, right? So seller financing can be a red flag for tax planning. Another red flag is it's a non-recourse loan. That means if Franklin doesn't make the payments on the loan, they lose the motel, goes back to the Romneys, but there's no other, right? They can't come after any of Franklin's other assets to satisfy the liability. In return, right, Franklin pays $75,000 of prepaid interest up front, and they give them a note, right, saying they'll pay them interest payments for 10 years and then a $975,000 balloon payment at the end of 10 years, right, which time they'll fully own the motel, or the liability will be satisfied. At the same time, right, this partnership of dentists isn't interested in operating a motel, and the Romneys, right, this is still their job. It's how they get their income. They want to keep operating the motel. And so Franklin leases the motel back to the Romneys, right? It's a sale and lease back. The lease payments are exactly equal to the payments, right, to the annual payments on the note, right? So probably in practice, right, so the Romneys are paying a lease, right? They're paying rent to Franklin. Franklin's paying interest. The amounts exactly offset each other. And so probably no one is actually even sending money to anybody. All right, because those payments are equal. So why would they do this? Right, so these dentists have a lot of ordinary income, and back, right, this was, I want to say this was in the 70s, and marginal tax rates were very, very high for high earners, right? We're talking 77%. So what's going to happen is, right, for one, they have interest deductions. And, right, but the big thing is, right, if we think back to chapter 10, is real estate, right, like a motel can be depreciated. And back when this happened, depreciation was more accelerated. So Franklin is basically getting big depreciation deductions, right? So they're reducing their taxable income, but they haven't really lost anything, right? That's the goal of a tax shelter, is to create deductions that aren't matched by real economic losses. So they get a depreciation deduction every year for 10 years. At the end of 10 years, they're not going to make this balloon payment. And I think one of the way they screwed up is they really overvalued the motel. It's not worth $1 million, right? But at the end, at least they're going to not going to make the payment. They're going to lose the motel. Then they could have another loss, right? When they lose the motel, that they can take as a tax loss, right? So that was the goal of this tax shelter. This one, right, the IRS targeted and caught, and they lose in court. The court says this is basically, right, not a real transaction and you can't claim these deductions. So this was happening a ton, right? I mean, it still happens, but it was huge back in like the 70s. And so if you're Congress, if you're IRS, how do you stop this? Because you're losing a ton of revenue. People are feeling like rich dentists aren't paying their taxes and losing faith in the system. So one of the ways we stop this is through the passive activity loss limitations. So a passive investment like this, where like a partnership, S corporation, LLC, a pass-through entity or direct ownership in rental real estate. It's passive if, right, if you're an owner who doesn't materially participate, right? Like in Franklin, they owned the motel, but they had nothing to do with its day-to-day operations. Right, if you participate in rental real estate, or if you're a limited partner in a partnership, you're assumed to be passive. To show that you're not passive, you have to prove that your involvement is regular, continuous, and substantial. All right, and so obviously this is subjective and fact intensive. There's some tests that the IRS has put out as sort of safe harbors. So if you participate more than 500 hours during the year, you can be considered to be active. If your activity is substantially all of the participation in that activity, then it's not passive, right? So if there's a farm and I am the only one, right, pretty much who works on it, including any employees that I pay, I still work the most. Pretty much, I do all the work. It's not passive. Some other things, if you do more than 100 hours, and that's not less than anybody else's participation, right? And so there's a bunch of other safe harbors. Here's a fun tax court case. All right, so what do we see here, right? And this is true, right? I'm not making any of this up. There was an attorney, right? Attorneys and dentists, they're always looking, one, for tax shelters, two, to be able to tell people that they're a farmer and not a lawyer. So this attorney owned a farm in Turkey, Texas. He had an arrangement with a real farmer named Clinton Pig, real name. All right, so he had like a sharecrop arrangement. So Mr. Pig planted and harvested the crops, but the taxpayer who owned the farm, he had to take care of the infrastructure, maintain equipment, clear the land, and build traps to bait wild hogs with Kool-Aid, all rights reserved, and corn millet, so they could be eradicated with semi-automatic weapons. Taxpayer didn't keep good records at the time, but he was able to satisfy to the court that he spent more than 100 hours in the farming activities, and this was more than any other individuals, right, including Mr. Pig. Right, so because he was able to show he was a material participant, he was able to deduct his losses, right? The issue here is passive loss limitations. Right? The IRS is saying he can't take those deductions. The attorney wins in court that he can deduct them because he's shown to be active and not passive. So picture of a wild hog. Let's see. More picture of some wild hogs. My parents loved that movie. Okay. So if you have a passive investment, right, you're not regular, continuous, and substantial. You're a limited partner, right, or you just own rental real estate passively. Your income from that activity is ordinary income. It's gross income. Your losses, can only be deducted if you overcome 3 hurdles: the tax basis limitation, the at-risk limitation, and the passive loss limitation. So the tax basis limitation says you can only deduct losses up to the amount of your basis in the activity. So your basis is what you have invested in the activity, right? What you paid for a share. So any cash invested, any share of income that the entity earns and doesn't distribute to the owners, and your share of debt. Your basis will go down anytime the partnership distributes cash to the owners, or anytime there's a loss. The at-risk limitation is often the exact same thing as the tax basis limitation, right? It's what you have invested in the activity that you have, but that you have a real risk of losing. So this is different than tax basis for certain types of debt. There's certain types of debt that the partner is considered not really at risk of having to repay if it's defaulted. And that could mean your at-risk limitation is lower than your tax basis limitation. All right, so for example, HUD buys an interest in an LLC for $50,000. There's no debt. The LLC has a loss for the year. His share of the loss based on his ownership percentage is $70,000, right? Because his tax basis is only $50,000, what he's contributed, then $20,000 of the 70 is limited. Right, so far he can deduct no more than $50,000 as his tax basis. Right, because there's no debt, his at-risk amount is also $50,000. So $50,000 so far has survived the tax basis and at-risk limitations. Our third limitation is the passive activity loss limitation. Right. This says if you have a loss from a passive activity, it can only be deducted to the extent that the taxpayer has income from other passive activities. Right. So passive losses can only offset passive income. Or if you sell the passive activity, you deduct the loss at that point. So suppose in addition to his interest in that LLC, HUD has passive rental property produced $8,000 of income during the year. So how much of his $50,000 loss that survived the tax basis and at-risk limitations can he deduct? The answer is $8,000, right? Because that's the extent of his passive activity income. So he only deducted $8,000 out of a $70,000 loss. What happens to the rest is that, right, once he got to passive activity loss limitation, he had 50, but he could only claim 8. So the other 42,000 is a passive activity loss carried forward, right? Which it can be carried forward indefinitely. And then there's another 20,000 that is considered an at-risk carry forward. All right, so that's passive activity loss limitations, trying to prevent tax shelter activity. So I'm always impressed every year. I have a couple of students who recognize what this animal is. I don't know, you may recognize it. Somebody always knows that this is a chinchilla. And I show this because chinchilla farms were a common tax shelter back in the day. All right, when I learned about that, I remembered when I was a kid, my uncle owned a chinchilla farm. So I always wondered if it was a tax shelter, but I'm pretty sure, he's passed away, so I can't ask him, but I'm pretty sure he was a sincere, good faith chinchilla farmer, right? They raise these things for their fur. All right, one last thing we want to talk about is the rental real estate exception. All right, we said rental real estate is a passive activity. You can show that you're a real estate professional, right? The IRS has specific regulations on this, right? But it's pretty strict as far as how many hours you have to spend actively managing real estate to be a real estate professional and not have it be passive. So a lot of people who own rental real estate, right, they have passive activity income. They would be subject to they would only be able to deduct losses to the extent that they have income from other activities, which could be pretty limiting, right? But a lot of more modest middle-class people might own rental real estate. And so there's an exception for that. And because real estate can generate a lot of losses, especially because of depreciation. So suppose mom and pop own a home they rent out to students at the local university. Pop approves new tenants and makes repairs when needed. Their AGI before considering any income or loss from the rental property is $90,000. Their loss from the rental property for the current year is $16,000. If they have no other sources of passive income, how much can they deduct currently? Right, so under our normal passive activity loss limitations, they couldn't deduct anything because they have no passive activity income, right? But because of the rental real estate exception, they could deduct up to $25,000 currently. So in this case, mom and pop could deduct $16,000. All right, so the rental real estate exception says if your AGI is $100,000 or less, you can deduct up to $25,000 of losses from rental real estate. You just have to own at least 10% and be involved in management decisions, right, to be considered an active participant. And for every dollar above 100,000 of AGI that you have, you lose 50 cents of this 25,000. So by the time you make 150,000 of AGI, you're no longer eligible for the exception. Okay, that's chapter 7, right? Not too bad. We'll try to post some practice problems, right? Especially for doing the gain and loss netting is the hardest part. And we're almost there.